New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
Happy Friday, everyone, and the first trading day of March and the first day of Women's History Month. Futures near the flat line this morning, despite stocks ending on a positive February and logging 4 months of consecutive gains. We'll see if markets momentum can continue.
And regional bank stocks taking a hit this morning, dragged lower by concerns at New York Community Bancorp, a CEO shakeup, also a warning of material weaknesses in internal controls, putting investors on edge. So let's get right to it with the 3 things that you need to know, your roadmap for the trading day. Yahoo Finance's Alexandra Canal, Akiko Fujita, and Jared Blickery have more.
Hey, Shauna. Well, it's safe to say investors had a great February. Stocks are rallying to close out the previous month, notching a 4-month winning streak. Both the Nasdaq and the S&P 500 logging their best February return since 2015. Stock futures, though, edging back just slightly this morning.
Shares of New York Community Bancorp plummeting this morning. The company disclosing the exit of CEO Thomas Cangemi effective immediately, citing weakness in his internal controls. The bank also revising its fourth quarter loss higher to $2.7 billion from $250,000. All of this comes just 1 month after the commercial real estate lender reported earnings, slashing its dividend and setting aside more for loan losses.
And the price of Bitcoin falling this morning just a tad. The rally seems to be taking a slight pause after surging 5 straight weeks. Bitcoin currently holding above 62,000. The leading digital currency is still within range of a fresh all-time high.
Our top story today, the market rally. Stock futures trading near the flat line this morning, but the major indices closed out Thursday's session with 4 straight months of gains. Now the Nasdaq Composite and S&P 500 also hitting those record highs. We had the best February that we had in almost a decade since 2015. And we bring this up, Brad, at the start of this trading day, at the start of a new month, because I think many investors and many on the street even trying to ask themselves whether or not this rally is going to continue, whether or not the gains that we've seen, a lot of that fueled by really what had been driving the market for much of 2023. And that was a handful of tech stocks, and it was a lot of the excitement surrounding the AI rally. We had initially seen some signs of that rally broadening out just a bit. But as we enter the month of March, once again, it still remains all about AI and a lot of the excitement there.
And of course, the big test was this earnings season and how much. A lot of that fodder for conversation and where the ambitions for companies that were actually deploying real AI solutions that actually pass through to their margins, where that's actually being realized right now versus some of the far off targets that many of them have set. And here's what's also interesting about this earnings season. And here's some data from FactSet and the key metrics that they've been tracking. The percentage of companies actually beating EPS estimates or beating revenue estimates right now is below a 5-year average. Now, why do we bring that up? There perhaps is a little bit more hesitation for companies to get ahead of their skis, at least in their forecast, knowing that we could be facing this higher for longer type of Fed where the interest rates are not going to be as beneficiary to some of the major deployment of capital, both at the individual and then additionally at the large company level here. And for many of these companies that are trying to right-size their operations with fears of a recession still lingering, but this soft landing firmly seeming like the Fed has been able to really put that forward here. And speaking of the Fed, you had one of the Fed presidents, Loretta Mester, yesterday saying 3 rate cuts in 2024 feels about right. That's a far cry from the 6 or 7 that we were talking about this year.
It is. And then we also had Torsten Slack over at Apollo, the chief economist there, saying that he actually doesn't see the Fed cutting rates here in 2024, which is a massive shift from the narrative that we heard from the street and really what forecasters had entered the year anticipating when it comes to Fed policy. So let's talk a little bit more about that, because investors are keeping a very close eye on any clues to the Fed's path forward after the bank's preferred inflation gauge, PCE, logged its lowest annual rise since March of 2021. Yahoo Finance spoke to Cleveland Federal Reserve President Loretta Mester on if her baseline was still 3 rate cuts in 2024, where she sees Fed policy moving forward. And here's what she had to say.
Right now, that feels about right to me. If the economy evolves as I anticipate it will. But again, if the economy moves in some unexpected way, we want to take that into account.
But how is this interest rate environment impacting investment strategy? And what does it mean for growth this year? We want to bring in Stephen Janau. He is the Bank of America's U.S. economist. Stephen, it's great to see you again. So we brought up the clip that we heard, or the soundbite that we heard from Fed President Loretta Mester yesterday, saying that she still expects cuts before the end of the year. Torsten Slok coming out this morning saying he actually doesn't expect cuts now in 2024. What is your base case?
Well, I would say we lean more towards Loretta Mester, the Cleveland Fed president. So we are looking for 3 cuts this year. We haven't changed. We did recently revise up our growth forecast, but that hasn't really changed the story for the Fed. I think what you're seeing is that economic momentum's continuing to progress. We expect growth to be 2.1% this year, up from 1.2% previously. So pretty meaningful upward rise, but we think that disinflation can continue. And disinflation can be enough for the Fed to really embark on a very gradual cutting cycle. 75 basis points this year, 3 25 basis point cuts. That's not a lot. That's not really a significant amount. It's just reducing the level of restriction, given that you've seen so much progress on inflation, notwithstanding the detour we saw in January.
Where are we already seeing deflation, and where will that perhaps and move from the disinflation to the deflationary type of conversation for a lot of consumers who are still seeing some of the core prices that they're tracking perhaps hitting the wallet?
So where we're seeing kind of deflation and outright prices coming down is really on the good side. And that's been a big driver of the rapid disinflation we saw last year. So used car prices have fallen significantly. Apparel prices are down. Household furnishings are declining. They're still up relative to 2019. We're not going to go back to 2019 prices all of a sudden. That's not really how inflation works. But we have seen outright deflation there. What we think will happen this year is that over time, we're going to see goods deflation kind of subside. It's going to go from being kind of a real downward drag on inflation to being just more of a neutral setting. So it's not really going to put that downward pressure. But then we're going to see a handoff to shelter inflation. Rent and OER should continue to moderate this year. We've seen asking rent inflation measures continue to move lower, continue to normalize towards pre-pandemic levels. That typically leads the CPI, the PCE measures. So we'll get that handoff, and that will allow for ongoing disinflation this year. So a little bit more progress towards the Fed's 2% target. We think core PCE inflation will end the year at 2.6% year over year now. That's up 1/10, but down about 3/10 from last year. So moving in the right direction, but it's going to be a little bit more gradual this year, a little bit slower.
Stephen, when you talk about your GDP forecast, you do expect to see faster growth this year, slower growth in 2025. Walk us through that thesis and why you expect to see more of that growth front-loaded at this point.
So what we think has been happening, and this was really true last year as well, is that we've basically seen a supply-side driven rebound in the economy. What I mean by that is that we've seen a huge influx in labor supply. Some of that is due to the rebound in immigration. Some of that is also just due to greater cyclical participation rates. So what that's allowed the economy to do is basically operate at a higher speed limit. So what I mean by that is we're able to grow without necessarily overheating. You see it in the labor market. We're adding over 200,000, 250,000 jobs per month. I think it was close to 289,000 jobs over the last 3 months. And that's not putting downward pressure on the unemployment rate. And also wage inflation is still going down. So that's because basically we're in this period of time where supply is normalizing. And not only normalizing, we're seeing labor supply growth. So that means that potential growth is higher, allowing for growth to actually continue at a higher rate without actually causing real overheating problems, without causing significant inflationary pressures. So we think basically potential growth has shifted higher in the near term temporarily due to that labor supply rebound. And that will allow this economic momentum that we saw last year to really persist into the first half of this year and really most of 2024 before things kind of moderate back towards long run dynamics in 2025.
So just to add on to that then, Stephen, how does higher for longer, if we see less cuts than we were anticipating coming into the start of this year, how does that impact the consumer resiliency that we've continued to track here?
So we didn't make a change to our Fed call. So this is kind of the same story that we have in terms of the Fed, where we think basically monetary policy higher for longer, how it's really affecting the consumer right now is really on things like credit card loans, auto loans. So where consumers are starting to fall behind on their payments. But when you look at the aggregate household sector and you look at measures like debt service ratios, when you look at the effective mortgage rate, all of these are still at very low levels. So household balance sheets are fairly insulated in aggregate from the Fed's higher for longer policy. Now, that doesn't mean that won't, that will persist forever. More people will start to fall behind on payments. Student loan payments will, maybe add to delinquencies a little bit. And that's where you start to see higher for longer, really pinch kind of consumer spending. But that's something that will slow things down a little bit. It won't necessarily lead the consumer to actually cut back or lead to a contraction in consumption spending.
Stephen Juneau, who is the Bank of America U.S. economist. Thanks so much for taking the time this morning, Stephen. Appreciate it. Thanks. The AI trade picking up some steam this morning. We're tracking two trending tickers on our site, AMD and Dell, both climbing pre-market around AI hype. Yahoo Finance's Jared Blickery, he's over at the big board tracking the market action. Jared, let's start with Dell. What are you seeing there?
I'm seeing a huge move in the pre-market trading to the upside, up 30%. Now, this is going to be good for a fresh record. The opening print could be around $120. That's $122.48 that you're looking at right there. And this is a stock that has been on fire, up 23% year to date. That doesn't include the 30% in the pre-market. And over the last year, we can see gains there of about 132%. Now, there is a tie-in to AI, and this has to do with the chips that are powering it. And AMD is getting a ride off of it this morning as well. The stock was up about 9% yesterday, and it was up 3%. It's up 3% now in the after-hours trading. And here's the tie-in, and this comes from a research note from Melius Research. Traditional server CPUs picking up help support AMD margins, and it lends further upside to its data center segment. Also, we believe Dell received meaningful orders for the AMD-made MI300X. That's a new chip that will start shipping this quarter and pick up throughout the year. Now, there have been concerns that AMD is really lagging Nvidia in terms of AI technology. This doesn't necessarily resolve that one way or the other, but it does put AMD into the forefront of investors' minds. These are the year-to-date percentages in the background along with the pre-market quotes. So AMD up 30%, another 3% in the pre-market, but that doesn't really compare to Nvidia, which is up 60%. And by the way, going to tack on another 1.2%, probably good for another record on the open, guys.
All right, Jared, thanks so much. Let's talk about another trending ticker here on Yahoo Finance, and that is New York Community Bancorp. Turmoil surrounding that bank is dragging the sector, dragging regional banking stocks lower. Shares of NYCB plunging 21% in the pre-market after the New York-based lender warned that fourth quarter losses blew into $2.7 billion. The company also disclosing the departure of its CEO, citing, quote, material weaknesses in its internal controls. Now, the stock facing some pressure so far this year after it surprised analysts just about a month ago by slashing its dividend and setting aside even more money for loan losses. So for more on the bank's troubles and what happens next, we want to bring in David Shiverini. He's Wedbush Managing Director of Equity Research, Midcap and Regional Banks. David, it's great to have you back on Yahoo Finance. So we spoke just about a month ago when we first got the announcement of the cut in the dividend, when we first got the announcement that they were setting aside more money here for losses going forward. Now we have the extent of the profit hit here in the most recent quarter. What's next for New York Community Bancorp?
Yeah, I think the key focus going forward is going to be their deposit flows, right? With today's stock action, the stock action over the past month, people are going to be wondering, what's happening to their core deposits, given all the turmoil that the company's going through. Now, what they had said about a week after the earnings release is that total deposits were up $1 billion year to date, but it was unclear how much they were relying on brokered deposits to generate that level of growth. So the concern is core deposits, particularly non-interest-bearing deposits, which of course come with zero cost, whereas brokered deposits have a similar cost as borrowing. So that could pressure their net interest margin. So that's really the key concern here. The other concern naturally is with the deficiencies in their internal controls related to their loan review process, it opens the door to them potentially having to set aside more reserves related to their CRE exposure. So those are the two key items that investors are looking at.
Have they made the necessary executive changes to really assure investors that going forward they will have a handle on this?
Yeah, so Sandro Danello, he really navigated Flagstar coming out of the financial crisis, and he did a fantastic job doing so. And I think that's why they elevated him and brought him into the executive chairman role and now president and CEO to really work with the regulators and get the bank back on track. So I think it is confidence inspiring for the bank.
David, this has raised some concerns just about the risk that this could pose to the larger regional banking industry. Is this a one-off case scenario, or is there any risk of contagion?
Yeah, so the main risk in New York Community's portfolio, at least in our view, is their rent-regulated multifamily exposure, which is 22% of total loans. That is far and away the highest in our coverage. The next highest is 5%, so a big step down. So it does seem to be idiosyncratic to New York Community Bank, at least on an acute basis. Now, will CRE be a headwind for the overall banking industry? Yes, absolutely. But the rest of the banking industry will have a runway to set aside reserves as we go. So CRE is a headwind, but in the near term, this is very much focused on New York Community Bank with their specific exposures.
David, diving into that a little bit more, just CRE being a headwind here for the regional banking sector at large over the next couple of quarters. When you talk about that challenge, I guess put it in perspective for us. How big of a hit do you see this potentially being to some of those biggest players within the space?
Yeah, so the biggest players, like the money center banks, they should be okay because they are subject to elevated capital requirements. Whereas some of the mid-sized banks, they're the ones that could, and smaller banks, they're the ones that do have outsized exposure to CRE. So it is a concern, particularly in this elevated interest rate environment, and especially since the Fed has been incrementally more hawkish over the past month or so. When these borrowers look to refinance, that's where issues could arise. So maturities will be a key item to track this year.
And David, just lastly, while we have you, where are the other better options in terms of the regional banks that you're tracking right now? I mean, we're looking at New York Community Bank down 54% year to date here. So a lot of people have obviously flowed out of this stock. Where else might they be taking opportunities to flow into?
Yeah, so our top picks: First Horizon, FHN, First Citizens, FCNCA, Western Alliance. We like WAL. They were, caught in the crosshairs about a year ago, but they've right-sized the bank and steadied it. So those are a few names that we like here.
All right, David Chiaverini, always great to get your insight. Thanks so much for hopping on with us this morning. Wedbush, Managing Director of Equity Research, Midcap and Regional Banks. Thanks, David.
Thank you.
Well, coming up, shares of Fisker plunging on a very stark warning. We will break down Yahoo Finance's top trending tickers and that loss of nearly 40% in the pre-market when we come back. Time for some trending tickers here on Yahoo Finance. First up is Fubo. Shares jumping in the pre-market, up just about 14% after reporting a record number of paid subscribers in North America and a 29% increase in revenue from the levels that we saw just about a year ago. They had 1.62 million paid subscribers. That was up 12% on a year-over-year basis. Total revenue of $402 million. Now we know the focal point and really what has been driving some of the action in Fubo stock and really more broadly speaking throughout the sector was what we just had their CEO David Gandler on Yahoo Finance not too long ago, a week or so ago, Brad, talking about the antitrust lawsuit that they just filed to block Disney, Fox, and Warner sports streaming deal, saying that it's anti-competitive, that it's going to destroy their business. That was the focal point here for investors, for shareholders, for analysts heading into these results. And it looks like at least up until now, the company obviously improving on some of those key metrics. But the question is that future subscriber growth and how they're going to compete if they are at that disadvantage. Yeah,
it's amazing, actually, the achievement for this all-time high in the average revenue per user right now in this interim period, $86.65. But you got to wonder if a consolidation or at least a partnership would materially impair that type of ability to extract value from some of these core customers, which they were able to see 1.618 million paid subscribers. That's up by about 12% year over year. If it would materially impair that figure, especially as a more competitive offering gets brought to market here. And I think that's exactly what investors have been trying to get ahead of. That's why the stock's down year to date by about 34% here.
All right, well, let's get to another mover here, this time to the downside. Fisker shares plunging in the pre-market after issuing a going concern warning saying it's going to cut 15% of its workforce. Now, the EV maker missing its production target of 13,000 vehicles. You're looking at losses of 37%. That is because of that warning that it might need a little bit more capital in order to survive. They've had this transition taking place from the direct-to-consumer model to the dealership network. Fisker saying that they are saying, blaming some of the weakness there on that transition, saying that it has hurt sales, but a wider than expected loss. They missed the production target. Obviously, very tough to make a strong investment case for this company, given the fact that the visibility, at least in the near term, is not too clear at this point.
Yeah, moving to the dealership model, and in which they've now signed 12 dealer partners in the U.S. and Europe, that actually makes it a little bit more tricky for margins here, because when you go into a dealer, what are you trying to do? You're trying to haggle. You're trying to get the best deal. So that is one of the headwinds that I think investors also trying to really price in here. What's the actual pass-through that Fisker would still be able to get in and now model that they're shifting to partnership with more dealers? Those dealers are going to have more incentive to just get cars off the lot or work through inventory that they've signed purchase orders for. And they ultimately did report earnings here, preliminary Q4 2023 total revenue of $200.1 million. That's an increase from the third quarter. But ultimately here, you got to think about exactly where those gross margins are going to continue to come in at, down 35% in Q4 2023. Stay tuned for our 4 p.m. hour. Julie Hyman and Josh Lipton going to speak with the Fisker CEO, Henrik Fisker. You do not want to miss that. And staying in the car lane, if you will, Elon Musk is suing OpenAI. Not so much the car lane. Elon Musk is suing OpenAI and its CEO, Sam Altman, saying the company is no longer following its original goal to create AI to benefit humanity and instead has opted to focus on profit. Now, Musk is claiming in the lawsuit that this pivot breaches their contract here. Musk had also brought up that he was originally presented with this idea of an open source type of AI platform and like language learning model capability by Altman here. Larger question, as we've seen some of these suits or allegations come forward, where this will net out, especially among some of the big investors that OpenAI has been able to take on billions of dollars from at this point.
Yeah, I think the question is what the outcome is going to potentially look like, what some of those changes could result and end up being as a result of this lawsuit. But really, this is just the latest in this ongoing strained relationship, to say the least, between Elon Musk and Sam Altman. So Elon Musk here filing this lawsuit saying that the company has really just strayed from that original non-profit mission. And we know that Musk was an early investor within the space, co-founded OpenAI in 2015, stepped down from its board in 2018. But within this lawsuit, bringing up the issue that he's saying that their deal here with Microsoft for more than $10 billion. That really represents the fact that it has strayed from their initial mission. And he went on to say that OpenAI has been transformed into a closed source de facto subsidiary of the largest technology company, Microsoft. So I think the question here is just where this ends up, how this ends up, and what changes could in fact be implemented as a result of this. All right, well, we are minutes away from the opening bell on Wall Street, just about 3 minutes after the best February for the markets in nearly a decade. What is March going to hold, and will that rally hold on? For more on that, we'll be right back.
Well, we're standing by for the opening bell on Wall Street. We're just seconds away here. We are mixed in the futures right now. The Dow down by about 0.1%. How dare that on its Friday. And the S&P 500, that's flat, just barely to the upside. And the Nasdaq futures, you're seeing that flat, just barely to the upside. We'll see exactly where we net out at the opening cross to begin today's trading session. But until then, here's a look at the New York Stock Exchange and the Nasdaq. Wow, you've got GBTC ringing the opening bell here, and BitFuFu. Man, that's a fun name. All right, got both of them kicking off today's trading activity here. Yeah, put a little funfetti in the air. It's Friday. Why not? Celebrate. All right, GBTC and then BitFuFu. I could just say BitFuFu all day. Feel happy. All right.
Big crypto then.
Big crypto. Big crypto energy. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange, and Jared Blickery on standby at the Interactive. The S&P 500 and the Nasdaq closing at record highs this week, but not all good news from markets. More turmoil at New York Community Bank, putting pressure on the sector. Maddie, I'm wondering what you're hearing from investors on the trading floor at the NYSE.
Well, the big question here, Brad, is something that we've been talking about throughout the turmoil we've seen in these regional banks. Is this going to be yet another idiosyncratic story that you can blame on things like poor management and inability to look ahead to how to handle the higher for longer environment? Or is this indicative of a broader challenge within the regional banking sector? That is what's going to define how that overall sector continues to perform. But zeroing in on NYCB, that stock is down over 25% this morning as the market opens up here. And that is due to internal challenges that they announced. They announced new leadership with the CEO there. And as a reminder, this is the bank that
had acquired Signature Bank almost a year ago. The question being, are they going to be able to figure out how to navigate and keep onto any deposits that they still have in their holdings here as the Federal Reserve keeps those rates high, and their challenges with that seem to be continuing. Now, I also want to look at Apple because that name is down a little over 0.6% in the market open here, and that is because Goldman removed them from their conviction buy list. Still a buy, of course, but yet another tough day for Apple. I'll be interested in seeing whether that can turn around to bring us into higher highs throughout the rest of the day here. And of course, guys, as always, we're looking at some Fed speak. We're going to continue to monitor what Federal Reserve members have to say about the higher for longer environment and when we can expect to see cuts in the future.
All right, Maddie, thanks so much for breaking that down for us from the floor. Let's head over to Jared Blickery as a closer look at some of the red that you're seeing on a screen there. A lot of crypto names under pressure this morning.
Yeah, what is this? I'm not used to this. I'm going to change this. Guess what? This is one day. You can see Bitcoin down just over 1%. So is Ethereum. Here's the 7-day view, and this is more like it. Bitcoin up 21%, Ethereum up 15%. Critically, I'm noticing a lot of the other tokens, some of the smaller ones, catching up. Now, I don't want to say it's a good thing that Dogecoin is outperforming everything else, but it has not been a participant in a large degree of the rally. It's been Bitcoin and Ethereum leading, with some of the smaller guys lagging. This is a change, for better or for worse. So we got Shiba Inu. I haven't charted this in forever. That's up 50% over the last 7 days. And take a look over the last year here. You can see very, very low. I mean, how many zeros is this? 4 zeros before the 1.5. But take it with a grain of salt here. We've seen the mega caps here of crypto. Mega caps of crypto, I'm going to call that Bitcoin. Now, this is up 164% over the last year. But it's not only crypto, it's also crypto stocks, which have been surging as well. And let me get a 5-day look, which counts for the days in this weekend. MicroStrategy up 46%, Coinbase up 21%. And let me just get a max chart of this because it has now recovered about 50% of its losses. And you can see that was its opening there when it came to market. That was top ticking the Bitcoin price. So half of that done, half more to go. We'll see what can catch up, but I'll show you it's not all winners here. Here's Bakkt, still down 93%, barely holding on to 62 cents per share, guys.
All right, Jared, thanks so much. Let's talk more about some of the broader action that we've been seeing play out in the markets because stocks aren't too far from the flat line here this morning shortly after the open. They're coming off, though, record levels for the S&P and the Nasdaq. Now, major indices logging 4 straight months of gains. So far this year, 50% of the S&P 500 gains can be attributed to just a group of stocks, the Mag 7 stocks. That's according to Yahoo Finance's calculation. So where do we go from here? It's a question everyone wants to know. Christian Muller-Glissman, he's Goldman Sachs head of asset allocation research, joining us now. Christian, it's good to see you. So certainly we have seen only a handful of stocks really catch much of investors' attention, really be the driving factor that we've seen in the rally over the course of the last several months. That concentration, do you view that as a risk here to the broader market?
I mean, not necessarily, because I think those stocks have done phenomenally well on the fundamentals, and you can justify that outperformance and to some extent the valuations you're trading at right now. What we would also say is that the macro picture is very subtly changing currently, and it has a much more of a reflationary flavor where it's less about rates relief, where kind of the Magnificent Seven obviously are huge beneficiaries, being longer duration, being more about longer term structural factors. So the market is shifting currently a bit more towards reflation, where actually the economy is doing very well. You start to see green shoots in global manufacturing. Yes, there's a downside. The inflation is also a bit stickier. The inflation momentum is less negative, but it could mean that the leadership within equities is broadening out a bit, where you can have like economically sensitive areas within equities maybe benefit.
Which areas do you see a reinflation trade most concentrated, and are there specific companies that are the biggest winners in that instance?
Yeah, it's as always not so easy because First of all, cyclicals have not really suffered as much as they would have normally if you have a big global manufacturing slowdown like we had in the last year. A lot of them have actually maintained margins, maintained profits, but they've run down inventories. So we're going through a restocking cycle, and we need to understand where the pricing power will be and where the companies can actually benefit from the pickup in manufacturing. We've been leaning in our research a bit more towards consumer cyclicals because we see a lot of strength there, real income growth supporting consumers. There's selective industrial areas like business services, for example, has been an area we've liked in Europe. So I think, it's still requiring a bit of a selective approach. The last thing I would say is small and mid caps have been a big kind of favorite area to kind of position for a bit more reflation, because these type of areas tend to be more economically sensitive, and they have suffered a lot. They're quite cheap right now. So that would be areas where you can look for. But we need to to be completely fair, we need to kind of see a bit of earnings news as well from those, because so far it's pretty early, those green shoots.
Christian, in your latest note, one of the charts that caught my attention, we've been talking a lot about some of the excitement that we've been seeing playing out within crypto, specifically Bitcoin. And you were tracking Bitcoin's performance, saying that it has now appeared to have reconnected to risk appetite. I'm curious what that signals to you, and whether or not this is some momentum here that you think is around to stay when it comes to the excitement surrounding crypto.
Yeah, I mean, as you know, Bitcoin is a quite interesting asset. First of all, it has elements of a real asset. It has elements of a commodity. There's some elements of FX. So from that perspective, we're still learning kind of what are the drivers of Bitcoin. And I think if we look at the historical correlations with different assets, we know it's been very linked to the dollar. So weaker dollar has historically been good for Bitcoin, but it's also been very linked to Nasdaq performance, and it's been very linked to equity performance. And if you see risk appetite pick up, and that obviously comes alongside often equities doing well, and the Nasdaq often being in the driving seat, I think that supports Bitcoin. But I think if we look at the recent shift, I would definitely say it's consistent with a broader increase in risk appetite, which reflects slightly better macro conditions, and also with the reset in volatility, which kind of drives a bit more risk appetite. So you can see that as you like. On the one hand, it's another signal that we're probably dealing with a relatively strong macro backdrop that supports risk appetite, which spills over to Bitcoin. You could argue Bitcoin had an incremental support by the launch of the ETF, which puts focus on it, which generates momentum. But you could also see it as a slightly concerning signal that maybe there's a bit too much optimism building at this point. I'm probably less worried about that, but I would still say, looking at this chart, you could be worried about that.
Is there a difference between risk appetite and FOMO, Christian, from your perspective? I mean, it seems like, especially with now a lot of focus on the Ether ETF, that Novogratz is believing that is going to come forward before the end of this year for sure. Now all of these things considered, there is more fodder for some of the FOMO trade to continue to persist here.
I think, risk appetite in most cases tends to be driven by fundamentals. And we've done a lot of work on that, benchmarking our risk appetite indicator to macro data, to different type of combinations of growth, inflation, different drivers of growth. And I would say that what we're dealing with right now is at least in part, if not to a large part, linked to macro fundamentals, which have been pretty strong coming into the year with a bit of a Goldilocks backdrop behind us. And now it's shifted a bit towards reflation. And obviously there's an element of FOMO usually at the end, where I think if risk appetite picks up, if assets perform very strongly, you kind of get some type of final capitulation of the last investors that are really following risk assets and riskier assets. But to be honest, we're not seeing that right now. If you look at fund flows, for example, year to date, there's actually been 200 billion of inflows into money market funds. If you look at the inflows into equities, it's been more like 20 billion. If you look in general at the flow picture, it doesn't show like this extreme bullish sentiment that would tell you that we're in a kind of strong FOMO environment. We see certain indicators quite stretched, futures positioning, some of the sentiment surveys. Options skew, kind of the cost of puts versus calls is very low. So there's some areas that arguably are stretched, but you don't have the breadth. You don't have the breadth that normally indicates that things have gone too far and it's pure FOMO driving the market.
All right, a lot of investors trying to distill that down and really make a sound investment decision as well. Christian Moeller-Glissman, who is the Goldman Sachs head of asset allocation research. Thanks so much for taking the time here today.
Thanks.
Coming up, we're talking with Antonio Neri, CEO of HPE, on the other side of the break.
HPE shares in focus after some sales results and overall results that may have surprised a few investors. Let's get right to HPE CEO Antonio Neri. Antonio, always nice to see you. I think a lot of focus today is on the double-digit revenue drop. Explain to investors what happened in the quarter, and then what did you see towards the end of the quarter?
Well, good morning, Brian. Thanks for having me. There is a lot to be proud about this quarter, although it was mixed in the sense that we beat our own profitability expectations. We continue to drive that recurring revenue, which was up another 41%. And obviously, we beat the EPS. But our total revenue was below our expectation. It was driven by three key factors, I would say. Number one, let's remind ourselves we had tough compares because last year, this time of the quarter, we had to ship all that backlog, and therefore we had that tough compare this time around. But I think people understand that. But really, the two key drivers of the kind of softening on the revenue were the networking slowdown in the market, which is consistent with our peers. And then second is the fact that AI, although is strong, we don't have enough supply, and part of that revenue we shipped in the quarter actually went to the deferred revenue. And that's going to be the case going forward because as enterprises ramp, particularly on the inferencing aspect, they cannot afford these large systems. They have to pay as you go. So that's why you have that dynamic. But overall, I mean, we continue to drive very strong profitability. In fact, our profitability was up 200 basis points year over year again. 600 basis points from 5 years ago. And we have an amazing pipeline ahead of us with a backlog in AI that now sits at $3 billion.
I really enjoyed a lot of the granular details, Antonio, you and your team talked about on the earnings call with respect to getting some of this new technology into companies and then companies setting it up. And I think you called out power and cooling requirements. I haven't heard a lot of other tech companies acknowledge that these things or these bottlenecks are happening. What exactly are you seeing with companies as it pertains to those things?
Yeah, Brian, I mean, when you think about AI, I think about of a life cycle, training, tuning, and inferencing. Much of the action we have seen to date has been pretty much on the training side. Think about large companies like OpenAI and others, but also the hyperscalers. And now we start seeing the uptick in the enterprise space, but the enterprise does not have all the capabilities in the data center with the power and cooling required to run these large systems. And that's why we have stood up 2 sites where we're going to host some of these environment in an as-a-service model for our enterprise customers. But you need a lot of power. To give a sense, 500 GPUs can take more than 2 megawatts sometimes of power. And so that's not very easy to come by, and therefore you have to work toward that goal and offer alternatives to those customers.
Do you think this is one of the risks of implementing this current crop of generative AI that investors may not realize?
Absolutely. I mean, the analogy I will give to you is not different than the Bitcoin, time we went through. Mm-hmm. You need an enormous amount of power, and that has to be also sustainable. So when I talk to enterprise customers, they really worry about the cost, right, against the return. They worry about the sustainability aspect and obviously the responsibility components of the data and how they protect the data. So that's why so far has been all on the training side, building from 100 billions of data parameters to 1 trillion plus. But now you have to deploy it, and that's where the action comes to bear. And this is where HP is uniquely positioned because we have unique expertise in the data center space because of our supercomputing heritage on how to run this in the most cost-efficient and sustainable way.
This doesn't sound like an easily addressed problem, Antonio. Does this take a couple quarters to fix and normalize?
No, listen, we adjusted our guidance to reflect mostly the networking softness that we saw. It's going to get better on the back half of this year. To be clear, we have no channel inventory problems. We have actually a very clean channel inventory. This is all about customer digestion from what we shipped the last 2 years. Remember, last 2 years, we grew almost 40% on a quarterly basis, year over year, consistently. We added $2 billion. And now we have a new baseline we need to grow from. But what I'm really excited, honestly, Brian, is that with the pending acquisition of Juniper Networks, we're going to be a networking company that delivers hybrid cloud and AI services through the platform called HP GreenLake. And GreenLake, it has been an enormous success. We crossed 31,000 customers this quarter. We added 3,000 customers in the past quarter. And now customers understand they can get a unified experience from the network all the way to the cloud and also consume the cloud services and AI services as they need, whether they pay CapEx or OpEx.
How difficult is it to get the chips, the AI chips that you need to satisfy your demand?
Well, obviously has been a challenge. It's getting better, and now we're going to have multiple transitions in the next 3 to 4 quarters with new set of chipset coming online. We got some, obviously, and we have a lot in the making, but remember, customers need to accept these systems, and that takes time. And in an as-a-service model, that's the impact, because it's not about the time of shipment you recognize revenue. It's the time where you deploy, you accept it, and then you consume it over potentially a 3 years period. But it's getting better. We have a lot of chips right now in the factory that we're working through the backlog, and we expect a significant uptick on the revenue conversion in the back half of the year.
On Juniper, Antonio, it's been a tough regulatory climate. It was believed just this week the Kroger-Albertsons deal got shot down. There's been other deals that are really being heavily scrutinized. When do you see the Juniper deal passing? And are you getting a little worried that you may not be able to get it done in this regulatory climate?
So we announced the transaction on January 11. We still of the idea that we're going to get this transaction closed between the end of this calendar year and beginning of calendar 2025. We said 9 to 12 months. We're working through the process, filing our approvals through the jurisdictions that really makes the difference. We're also working with the United States Department of Justice because obviously we need the Antitrust. But so far, we haven't seen anything that makes us concerned. So we are working very well with all of them, and we should expect more news in the months to come.
Lastly, Antonio, before we let you go, it's been the last time I talked to you, there was so much hype around AI. This was just a couple of months ago. Now we're at a new moment. You have the Nasdaq at record highs. Companies like Nvidia and AMD, their stocks are breaking through to new records. What's your message to investors? Because a lot of investors that we're talking to, average investors, they're getting pulled into this AI cycle, and I don't think they really know what they're doing. That's not me bad-mouthing them. I just don't think they understand what tech companies are working on and the valuations on them.
Yeah, obviously we have lived in a very hyped environment. At some point, this has to be more rational. And in the end, let's make sure that we make the right return for our shareholders, because as you see, the reality is that these technologies are very expensive and the margin is very compressed. And this is why HPE is pursuing profitable growth in this space. And you look at our server segment, Brian, is a testament. We delivered 11%, including the AI components of that. But I do believe as we go forward, there will be a rationalization of that. And really the question is, where is the value? And to me, the value of AI is about improving business productivity. And when you think about how to deploy this, it has to be sustainable. And that's a component that I don't think is in the equation yet. And then where you play when? And our view is that we're going to play in the network space first, and then second is bringing these accelerated computing in a way that's sustainable and easy to consume with the lowest possible cost. But it's going to take some time, and I think enterprises are early in that cycle, Brian.
Great perspective, as always. HPE CEO Antonio Neri, always great to get some time with you. We'll talk to you soon.
Thank you, Brian.
All right, we'll be right back on Yahoo Finance Live.
10 straight days. That's how long the ongoing cyber attack at U.S. health tech giant Change Healthcare has left many doctors around the world unpaid and pharmacies unable to fill prescriptions. United is set to issue an update today on the cyber crisis that's playing out. Yahoo Finance health reporter Anjali Khemlani is here with the details. Hey, Anj.
Hey, Brad, that's right. The 10th straight day for United Healthcare and its Change Healthcare subsidiary, which was attacked on the 21st last week. A ransomware group identified as Black Cat is behind the attack and is really interrupting what pharmacies and healthcare systems really rely on, which is the payment systems and prior authorization track. So if you see on the timeline, it started last week. Immediately after the attack, the company filed with the SEC alerting them about this. A couple days later, it finally came out who was behind it. Black Cat is known as a Russian-backed ransomware criminal group. They were expected to give us updates. They've been giving updates pretty much every day and been on the phone with healthcare system chief executives for days, trying to figure out how to work their around. They did shut down the system, but as it stands right now, because they haven't been able to get back online and looking at weeks at this point until when they can get back online, they're announcing or expected to announce basically an alternate route, possibly like a loan system, in order to get these things going, because this has literally stopped operations in their tracks for some providers and pharmacists. What Change Healthcare is a subsidiary of United Healthcare. It was acquired by the group in 2022 for $13 billion. It was initially challenged by the DOJ, and this is interesting because it kind of plays into what we're seeing, because they were worried about just how much power it was giving United Health, and also about the access to and the vulnerability therein to their competitors' information. And this is where that kind of comes in, because they have a system that essentially operates like a third party for payment processing, prior authorization, checking the credentials, and insurance for members. So that's why this is so important. Now, United did say that it was able to contain the attack and it didn't affect other parts of the business. So while some skeptics are saying that still remains to be seen, this is where things are right now. And so United in particular pretty much okay with setting up this system, because they were, if you recall, the chosen entity by the government to disperse $30 billion during the pandemic for that pandemic era. So they do have this sort of background of, in an emergency situation, being able to do something like this. So that's what they're relying on. So we'll definitely be hearing more later today, but that is the latest.
All right, something we will continue to listen for. All right, Anj, thanks so much. Well, coming up, we will break the University of Michigan consumer sentiment, get a better idea of how Americans are feeling about the economy. And after a record-breaking week for Bitcoin, we will speak with Grayscale's global head of ETFs about outflows from their ETF fund. Stay tuned. We'll be right back.
Welcome back. We've struck the top of the 10 a.m. hour here. Brad Smith alongside Shauna Smith. We're about 32 minutes into the trading day. Let's take a look at how things are shaping up right now. Markets, they're mixed after closing out February in the green, notching a fourth straight winning month. Nasdaq hit its first record close in quite some time, continuing the upward momentum this morning here. We're also tracking shares of Tesla, edging lower as the EV maker rolls out new incentives in China in an attempt to woo customers as competition heats up in the world's largest car market. Tesla also opening up its charging network to Ford this week, a move that could yield $6 billion in additional charging revenue by 2030, according to Auto Forecast Solutions. Plus, Plug Power shares, they're falling this morning after the alternative energy company posted a wider loss per share than anticipated in 2023. The company did say in its release its ability to continue as a going concern no longer exists. The CEO, Andy March, saying that the company is dedicated to boosting its financial profile in the year ahead. And lastly, let's talk a little SoundHound. SoundHound AI sliding after missing revenue in its fourth quarter, though the company still managed to significantly narrow losses. The company's fall comes after an impressive run on the back of AI enthusiasm, up more than 300% in the past month, however, down here today by about 15%.
Let's get to some breaking news. University of Michigan consumer sentiment data is out, and consumer sentiment slipping for the month of February. The index falling to 76.9. That was down from the previous reading and falling for the first time that we've seen in about 3 months here. And that figure coming in at 76.9, which was actually lower than all of the estimates in the survey of economists here conducted by Bloomberg ahead of this release. Now, consumers, though, do expect prices to climb at an annual rate of 3% over the next year. That was up from 2.9% expected in January. They do, though, see costs rising 2.9% over the next 5 to 10 years, which is unchanged from the prior month. But again, that headline number there, 76.9, the consumer sentiment index there falling from the previous month, and the first month that we have seen for the first time that index has fallen in 3 months, Brad.
Yeah, we have a comment here from the Survey of Consumers director as well, who said that consumers perceived few changes in the state of the economy since the start of the new year here in 2024. They appear to be assured that inflation will continue on a favorable trajectory. Sentiment currently 8 points shy of the historical average since 1978, just in case you were wondering how long this has been going back towards. All in here, though, the long run inflation expectations remaining at about 2.9% for the third straight month. That's staying within this range that we've seen of about 2.9% to 3.1% on that top end for the 28 of the last 31 months here. Also, let's talk a little Bitcoin here, a little bit more on BTC USD for you. But not all spot Bitcoin ETFs have had a good month. Grayscale's spot Bitcoin ETF has seen nearly $8 billion worth of outflows in the past month, according to Farside Investors. That's partially due to Grayscale having higher fees than its competitors. To break down what's next for the ETF, we've got Dave Laval, Grayscale Global Head of ETFs and Yahoo Finance reporter Madison Mills at the New York Stock Exchange, standing by. Hey guys, Maddie, I'll toss it on over to you.
Thanks so much, Brad. Dave, thank you so much for being here after ringing that opening bell. I know you've done it before. We just mentioned this record-breaking crypto rally. At the same time, you're having record-breaking outflows to your ETF. Talk to me about the discrepancy there.
Look, ETFs are about democratizing investing for investors, and this is really an opportunity to open up 30 trillion of advised assets to come into the asset class. So we're seeing lots of buyers come in, democratizing investing, and it's really about, the demand profile increasing, and we're super excited about that.
Talk to me about the profile of those investors that you're seeing coming in.
So ETFs for a very long time, even if you go back 30 years to SPY coming to market, the first ETF in the US market, we think of that as S&P 500, market cap weighted exposure. It's, pretty plain vanilla, but then it was an institutional class of investment, and it democratized the opportunity for every investor to have a real equitable experience to come into S&P 500 exposure. Similarly, 30 years later, we're innovating with the ETF and bringing Bitcoin to market. Now, Bitcoin was really something that was followed by institutional investors, but also by retail enthusiasts, but it really wasn't available to the advised market. It really wasn't available to financial advisors to put into clients' portfolios. With the advent of the ETF, which is a wrapper that's well understood by the advised market and is something that's understood by wealth management platforms, it affords the opportunity for advisors to allocate to their client portfolios, and that's 30 trillion of advised wealth in the US market.
And obviously, you have had record-breaking numbers in terms of assets under management, but we've seen that significantly dip due to those outflows more than any of the other spot Bitcoin ETFs on the market. Given that, have you considered lowering the fee?
So we came to market with 28 billion in assets, and we had 100% market share. So for us to expect that we were going to maintain 100% market share really wasn't something that we were looking at. So the outflows that we have seen have been expected. We anticipated that. Look, we have a premium fee for a premium product, and so that's where we're standing right now.
Have there been internal discussions about lowering the fee?
We are always, taking a look at our business model, but we feel very strong where we are right now, where the asset level is. And honestly, with this Bitcoin rally, we have demand profile, it's very strong. We have supply, going to be constrained coming up as we have the halving in about a month or so. We're really excited about the economics right now.
How are you strategizing around that halving that you mentioned?
Well, it's not really something that we're strategizing around because the halving is really built into the profile of how Bitcoin is built, and it's kind of coded into Bitcoin. So we're certainly aware of it. Again, Grayscale's a crypto specialist, so we come to market with a really differentiated offering in the sense that this is all we do, and this is what we're really focused on. And so we can be that crypto specialist for the advisors and for our clients, and we're really ready to educate the market.
In terms of educating the market, you are an ETFs guy, so I'm curious if you can talk to our audience of retail investors about how they should be thinking about, in terms of the mental framework, how much crypto should be part of a diversified portfolio.
So ETFs have long been building blocks for clients' portfolios and for advisors to utilize for clients' portfolios. On Grayscale.com, we actually, our research team has done a lot of work on what an allocation to Bitcoin might look like, or digital assets. And we found that up to a 5% allocation to Bitcoin is really where you kind of optimize that risk-return profile for, a traditional 60-40 portfolio. So obviously it's not investment advice, but and suitability for different investors and different risk tolerances. But, take a look at the research, and it's something that I think from Sharpe ratio perspective and risk-return perspective is pretty compelling.
From a macro perspective, are there any concerns? I'm looking right now at Goolsby talking about rates and inflation. To what extent do those macro concerns read through to crypto and Bitcoin beyond the rally that we're currently in?
Yeah, Bitcoin can be different things to different investors. So some people, might think of it as a currency. Others might think of it as an inflation hedge. Others might think of it as a digital store of value. And others yet might think of it as a piece of, transformative technology and nascent technology. So it depends on how your view of Bitcoin is, but it can be all of those things to all investors or different investors as well.
I know that some of your investors who have stayed with you are really into Grayscale because they see you as beating the SEC when it comes to approval for the spot Bitcoin ETF. I know that coming up next, you're seeking approval for an Ethereum ETF. Talk to me about where we're at in that timeline. Do you have an anticipated rollout date for that?
So we're in the process of applying for our Ethereum, private placement that's currently trading on the OTC markets to be similarly to GBTC uplisted to the New York Stock Exchange. That review timeline expires in the June timeframe, and we're eagerly anticipating the SEC's decision on that, and we'll be prepared to uplist if we get an approval.
And let's end where we started. In terms of the assets under management and the outflows, is there a bottom number that you anticipate getting to when it comes to assets under management that would change your thinking on fees or change your thinking on a strategy for getting in more inflows?
Well, we started at 28 billion in assets, and we're right now about 26 billion in assets. So there's been a crypto rally. We've had some outflows. It's what we've anticipated. We're very, very confident in our business model and being a crypto specialist. We have a 10-year track record. We're not going anywhere. This isn't a flash in the pan. We're super excited about the future of crypto and the future of digital assets for investors.
I know a lot of our audience is too, Dave. Thank you so much. We really appreciate it. Shauna, I'm going to toss it back to you and Brad in the studio.
All right, great stuff. Thanks so much, Maddie. And of course, our thanks to Dave Laval, Grayscale's global head of ETFs as well. We'll keep right here on Yahoo Finance. Stocks off to a mixed start here for the month of March. You got the Dow just below the flatline. The S&P and Nasdaq, though, heading higher. Can that recent 4-month rally continue? We've got Ariel Investments founder and CEO John Rogers next. Stocks coming off their best February in nearly a decade as the major averages recorded their fourth straight month of gains, with the S&P and the Nasdaq both in record territory. Does this rally still have room to run, and where are the best opportunities within the market right now? We want to bring in John Rogers. He's Ariel Investments founder and co-CEO. John, it's great to see you. Thanks so much for taking the time to join us here this morning.
Well, good morning.
John, let's talk about the recent moves that we've seen in the market. You're coming from the perspective of a long-time value investor, except a lot of the excitement recently has been surrounding growth stocks. I'm curious your perspective on recent valuations and whether or not you think we might be approaching the top levels of growth.
I think it's very, very worrisome. The bullishness is getting to be quite high. Anything with AI in it is going up and up and up. You know, valuations are really getting stretched. It reminds me a little bit about the turn of the century. When we got to 2000 and the internet stocks were booming. We had the internet bubble. And eventually, of course, that came to a bad end, and small neglected stocks did very, very well.
And so as you're looking at this environment, John, with the valuations getting stretched, as you mentioned, do you believe that there's going to be a wave of profit taking that has to initiate among some of the biggest holders or institutional positions within Mag 7 or the names that have benefited the most from this generative AI run-up and hype phase?
I think what happens right now is that, no one knows who the winners are going to be. There will be, one of these companies will be the next Apple that breaks all the records and becomes extraordinarily successful. But you can't predict today which will be the winners. And so there'll be earnings disappointments that will be massive. There'll be companies that are going to go up and they'll go down substantially. We've seen that time and time again. We saw that during the internet times. We even saw it back when the auto industry was booming, earlier last century. Few auto stocks did great, but many others just disappeared.
John, you mentioned some of those opportunities in beaten down names. One of the beaten down names that you are a shareholder in is Paramount. We heard their results out earlier this week. And this is a company that's really struggled to compete in a space that has an extremely high number of competition. I'm curious why you see value in Paramount and where you see that value.
Well, it's been very disappointing. It's one of our worst stocks over the last couple of years. It's just been extraordinarily disappointing. I think what we see there is that, Sumner Redstone always said that content is king. They have extremely valuable content. You think about a Sunday a couple of weeks ago where you could watch, the Super Bowl and see that great content and world record eyeballs watching the Super Bowl. You had the Grammys that were extraordinarily successful this year. You have so many great franchises from CSI to 60 Minutes. The content is there. You look at then, you go to the Paramount Studios where you've got Top Gun and Mission Impossible and The Godfather. It's very valuable content. And so we think they'll be able to monetize that over time. They might need a partner. Most likely they will need a partner because it's hard to be subscale competing against the giants. But we think that will be a possibility that will happen hopefully sooner rather than later.
John, any ideas of who would make the most sense when it comes to that potential partner? And then when we talk about, more broadly speaking, consolidation within the industry, is that going to better position, it sounds like you might think so, some of those smaller names that have been struggling?
Yeah, I think that the smaller companies are going to have an impossible time as the years go on. If you're one of the small streamers, you think about Paramount Global. We have a great contract with the NFL, extremely valuable. It'll be a decade or so before that contract gets renegotiated, maybe 9 years from now. And you'll start to think, if you're one of the small guys, you're not going to be able to have the dollars to compete with the giants. So I think what you'll see is that, the Netflixes of the world, the Apples of the world, realizing that they're the ones that have the scale, they'll buy some of the smaller companies and make it work, or some of the smaller companies will come together to be able to be a competitive threat for the big guys. But either way, everyone realizes the small folks are at such a disadvantage today. They can't survive unless they're able to come together and find creative ways to make sure that they have the resources to continue to have the best content.
John, would an Apple or a Netflix, would that be potentially the right partner here for Paramount?
Well, that's what I would think. I don't have any insight to those boards of directors or to be able to tell you what they're thinking. But sometimes companies that have been reluctant to make strategic acquisitions, 1 year, jump ahead a year or 2 or 3, they see a different landscape, they see a different future, and realize to be successful, they have to change their traditional thinking. And I think it'd be great for them to be able to have a wonderful, historic, place like Paramount. That studio is so valuable. That back lot is so valuable. Instead of trying to do everything yourself, why not merge with a company that has shown they can do it very well for a very, very long period of time?
John, it's been lauded and really noted over the multiple decades of your career, your contrarian approach to investing here. If there was a playbook that you're employing for the rest of 2024, what would it hinge on, and what would the core theme of that be?
I think that for us, we are contrarians. We like to buy things that are out of favor, things that are neglected and misunderstood. And so we've been focused on a couple of areas, not only the media areas, which we've talked about Paramount, but companies like Madison Square Garden Entertainment that owns the Garden itself, an extraordinary asset, the world's greatest arena. The Sphere, that has become one of the most talked about arenas in the world. We think that's a really valuable asset that's going to grow and thrive. And then you look at some of the leisure-related companies, the consumer products companies like Royal Caribbean. People are cruising more than ever. People are enjoying time away. We think that people love experiences. So we're trying to find those types of businesses. And then finally, some of the housing-related stocks that really had a difficult year last year for us, a few of the companies. So we look at an ADT, for example. They do so much with security around the United States, great partnerships with State Farm and Google. That's the kind of name that we think will do well in 2024.
John, it's really interesting here. Bloomberg was looking through some of the DEI mentions, diversity, equity, and inclusion mentions over the past year, and how they've really faded to the background, especially as a lot of companies seem like they are really afraid that they might be a political punching bag going into what's expected to be a vitriolic election cycle here. Your company has never shied away really from making sure that that's at the core, that's at the fabric of your investing, your diverse perspectives as well that you bring into the company. I wonder, from the conversations you have with CEOs, what you're telling them, what they're telling you about this period going forward, and how they continue to prioritize DEI at the same time as, perhaps trying to skirt some of the punching bag nature that they could get pulled into.
Well, I would say it's a couple things, because there's, of course, a lot there. But one, we are the most diverse money management and mutual fund company in the country's history. We were the first African-American money manager in the country's history, and we started 41 years ago. And having a dynamic co-CEO like Melody Hobson, who's simply a Pied Piper for diverse talent, some of the best folks from some of the best firms in the country want to come and work at Ariel, want to come and work with a dynamic leader like Melody. Both of us are also fortunate to be on some great, great boards. Melody is on the board of JP Morgan Chase and chairman of Starbucks. I'm on the board of the New York Times and Ryan Specialty and Nike. And we would tell you that all the companies we're engaged in and involved in from a board service standpoint are as committed as ever to diversity and inclusion. They're not going backwards in any way at all. And I think that that's not changing. Even though we know the challenge that came from the Supreme Court, corporations want to do the right thing. They want to be seen as progressive companies to be able to attract the best talent, be able to relate with diverse customers. They understand how important DE&I is for the future. So we're really committed there. And then finally, from our investment hat, when we talk to management teams, we constantly push them to be more diverse, to tell them if they go out and get the best talent, they're going to be able to grow and be more successful over the rest of this century.
John, such a great pleasure to have you here with us on Yahoo Finance today. Next time, let's do this over some hoops. Let's play some basketball. We know that you've
already beat Michael Jordan. I wouldn't be taking him one-on-one if I were you.
I mean, yeah, he's got that perhaps that title on his desk right there. John, thanks so much for taking the time.
Thanks. Thank you.
Certainly. Coming up, lawmakers avert a government shutdown for now. We're diving into D.C. policy on the other side of the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
we're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Today, President Biden is set to sign a short-term deal to delay a partial government shutdown after the measure passed late Thursday. The stopgap measure, it shifts the funding deadline to March 8th and 22nd, granting lawmakers slightly more time to get full-year spending packages passed. Joining us now, we've got Brian Gardner, Stifel Chief Washington Policy Strategist. So we're just kicking the can down the road once again here, perhaps just getting past Super Tuesday at this point. I mean, that would have had some different political implications here, but what most notably, once we get closer to that date, are the elected officials currently in Congress and the president going to need to find some serious solutions around?
Yes, actually, I don't think it's so much Super Tuesday. I think the optics of having a government shutdown with the State of the Union coming up would have been very tough for Republicans. So there are optics there, but more for the State of the Union. What needs to be done next? Well, there is a sense that there's an agreement on the top line numbers and that the two sides are coming together on the guts of individual spending bills for the rest of the fiscal year. The question is, can Speaker Johnson keep enough of his Republicans on board to support it? Because he's only got a 2-seat majority right now. As we all know, there is a group of conservative Republicans who will not vote for anything. They're never going to vote for any of these spending bills. They're never going to get the concessions they want. And without those, they'll never vote for them. So can Johnson get enough of his Republicans on board to get these through? I think we're heading in the right direction. I feel a little bit better than I did a couple of weeks ago about this. But the May 1 deadline to avoid sequestration is looming. And so that is an issue.
One of the other big issues, obviously, Brian, facing the re-election potentially of Biden, or really the general election looking ahead to the potential Trump versus Biden matchup in 2024, is how voters are feeling right now about the economy. We got that consumer sentiment reading at the top of the hour showing the first decline that we've seen in just about 3 months. I'm curious, from your perspective, what you expect to hear as we look ahead to the State of the Union, just in terms of the Biden camp, their messaging when it comes to the economy, and what they are going to try to do to shift that messaging leading up to November.
Yeah, I mean, the consumer confidence numbers had been riding a nice trend, and I thought there was a possibility that they could give, if the trend continued, it could give Biden a boost. We'll see how it plays out longer term. The message, I think, is going to lean into, I'm on your side. The economy is performing well. We're out of the inflationary period. Wages are outstripping inflation. And here I am fighting for you on healthcare, on bank fees, on travel fees. I'm on your side. That's the message. I care about you, and I'm the better choice to look out for your interests. That's the message you're going to hear.
What should investors who are continuing to pay attention to each economic data point that comes out and paying attention perhaps more so to the Fed than they are to politics, how should they be tracking the marrying of the two, at least in commentary right now?
Well, I think on the fiscal side, it's mostly noise right now, right? There's not a lot that's going to be done on fiscal policy. Regulatory policy is still important as the administration looks to wrap up its regulatory agenda before the first term runs out. I mean, next week we're going to have an SEC meeting on the climate disclosure rule. So you're going to see a number of those issues. But I think investors are quite correct to pay more attention to the Fed, because that's where more of the action is. The political side, the fiscal side, for the time being, for the rest of this year, is really mostly noise.
Brian, one of the big topics that we've been talking about now for several months, but specifically this week, has been the pushback that we've seen down in D.C. when it comes to M&A activity. We had the Kroger-Albertsons lawsuit here from the FTC earlier this week, the Journal piece about the probe into United Healthcare. I'm curious, if Trump were to win in 2024, do you expect at all a shift in policy or stance when it comes to M&A activity, or do you think it's going to be more of a continuation maybe of what we've seen under the Biden administration?
I think it leans more to a continuation than a lot of people appreciate. Some of the M&A antitrust moves that the Biden administration has undertaken originated at the end of the Trump administration. The Biden administration kind of took the ball and ran with it. Now they've gone further than a lot of Trump people may have wanted to go, but that's where the starting point was. And when you look at some of the statements that are coming out from kind of populist Republicans, especially in the Senate, J.D. Vance of Ohio, for instance, they're more, they praise FTC Chairman Khan. They're more in line with an Elizabeth Warren view of some economic policies, but certainly on antitrust. So this populist movement within the Republican Party is shifting the way that a lot of Republicans look at antitrust. And so for those who think that there's some big M&A boom coming if Trump wins, I think they're going to be sorely disappointed, because I see a subtle shift. I don't see a big shift.
Do you think, Brian, some of these mergers are going to continue or even eventually get approved despite some of this pressure that we've been seeing down in D.C. from the FTC and the DOJ?
I do, mostly because I think lawyers to the parties involved in the mergers have gone into these advising their clients to be prepared for litigation. Structure the deal in either in a way that avoids litigation, or be prepared for litigation. And I think those that have happened more recently, they're attuned to what's been going on. This is not a surprise, and so I think they will probably dig in and fight to get the deal approved. And until there's a shift in thinking among the courts, we haven't seen, the FTC and the DOJ have lost a number of suits. I think a number of these more controversial deals will ultimately get approved.
Brian Gardner, always great to talk to you. Thanks so much for joining us here this morning. Stifel Chief Washington Policy Strategist. Thanks so much, Brian.
Thank you.
Well, coming up, Autodesk shares climbing higher today after issuing strong guidance. We will speak with the company's CEO next. Autodesk shares climbing higher today after reporting an 11% jump in revenue from a year ago, also issuing strong guidance. The company doubling down on its generative AI efforts through new technologies. Let's talk about that, how big of a catalyst it could be for the company. We want to bring in Andrew Anagnost. He is the CEO of Autodesk. Andrew, it's good to see you today. Congratulations on another strong quarter here from the company. So your sales were up 11% in the latest quarter. You're across multiple industries. Talk to us just about what the underlying demand looks like for your products and services.
Yeah, well, thank you, Shauna, and thank you for having me on the show. Look, there's a couple of things that really underpin what's going on here. One, we're a very diverse business. We make software for people that make everything. Bridges, roads, buildings, products, you name it, somebody makes it with our software. But underpinning the environment for our customers, regardless of any short-term issues, is they have real sustained long-term capacity challenges. There's not enough money, there's not enough people, there's not enough resources to make, remake, manufacture, produce everything that needs to be made. And that's what's driving the ongoing and continual technology investment with us and with other players that are helping them get ahead of this capacity challenge.
Certainly, and so this is a multi-year process that you've talked about, developing certain life cycle solutions here. When you think about that multi-year process, I mean, how long are we talking? What should investors be tracking up against in order to see that filter through to some of the margins for the business?
Yeah, look, I think what you're seeing right now is the impact of those life cycle solutions that we've been rolling out. Obviously, we have a robust downstream business in construction now, which is really part of connecting design and make in the architecture, engineering, construction industry. People are buying into that, and we saw a lot of strength in our enterprise customers exactly because they were buying into our connected solution from design to construction. So you're already seeing that today. It's happening. There's going to be more showing up as customers continue to invest in the deeper integrations of lifecycle solutions we bring to market, and of course, with the rise of the automations that are going to be coming from AI.
Andrew, what does the runway look like for AI adoption? I'm curious just to get your perspective as a key AI player. Many investors view your stock as that as well. What do you make of this excitement that we've seen surrounding the technology over the last several months?
Well, there's always a hype cycle on these things, right? The real rewards with AI go to those who continue to produce meaningful outcomes with the technology. Remember, we've been in this game for at least a decade. We've been delivering machine learning-based, AI-based solutions to our customers for a while. And we have a long-term path for how we're going to improve the way our customers work with what they do today, the processes they have today, but also disrupt their processes quite significantly with new types of AI tools. So there's going to be an ongoing patient delivery of technology. There may also be a hype cycle out there where some people get disillusioned with AI in the short term, but you got to ignore that. The long-term potential here is gigantic.
Are we just scratching the surface, Andrew, when it comes to the AI cycle?
Oh, I think we are absolutely scratching the surface. I think what's happened here is things like ChatGPT and now all of the tools are associated with image and video creation. These have made AI real for people who didn't understand it before. It's understandable. I can see what it does. I can see the potential. And this is why people get excited, because now they understand it. We've always understood it, and you have not even begun to see the kinds of impacts AI is going to have on how people get their work done in the future.
Andrew, back when I thought I was up to snuff to be an architect, I was taking some architecture and design classes in high school, and I remember using AutoCAD. For the number of businesses that you've been able to add on for Autodesk here in manufacturing, media and entertainment, all of these things considered, where is that next major segment that you think is going to unlock the next kind of inflection point or growth point for Autodesk?
Brad, so you really highlight the journey the company's on. AutoCAD, standalone AutoCAD is now less than 20% of the company's revenue, right? We're a 3D modeling company and a lifecycle solutions company. And one of the things that's definitely unlocking that next phase of growth is this move to integrating the design and make life cycles together. But there's also interesting opportunities ahead with helping owners do exciting and interesting things with some of these new technologies, so that you not only manage how you design and make something, but how you use it over its entire life cycle.
What about healthcare? I mean, that's the one area that's not really mentioned here. And I feel like for a lot of the areas that Autodesk certainly could lean into, you've already got media and entertainment, you've already got manufacturing. It seems like there's that other kind of area that has a lot of spending, billions of dollars, trillions of dollars that goes into it as a system. Where's perhaps that industry focus as well?
Yeah, Brad, you're poking right at something that's really right in the sweet spot of where we service our customers. Healthcare is absolutely one of the growth segments for our solutions. They're investing a lot in building out new healthcare facilities, not just mainline hospitals, but senior care facilities, assisted living facilities. And they're also at the front line of investing in some of our digital twin technology, which helps them run and operate the facilities to the fidelity that they need to operate them at. Hospitals are, highly managed facilities that have lots of environmental concerns and also, safety concerns associated with them. So they actually are very interested in some of the latest technology to manage the whole life cycle of the building that gets created.
Andrew Eddinghaus, always great to have you here at Yahoo Finance. Thanks so much for taking the time this morning,
Pleasure.
CEO
Thank you so much.
of Autodesk. Thanks, Andrew. Well, oil prices slightly higher this morning after closing out a second straight month of gains. Joining us now to recap the moves that we saw in February and how that sets us up here for March is Ines at the big board. Ines.
Yeah, Shauna, and we are looking at oil that's up more than 2% for West Texas Intermediate, above the $80 a barrel level. That's the highest level for 2024, and it is the highest level that we have seen since November of last year. A couple of reasons why we are seeing oil prices go up. Again, as you mentioned, the second month in a row of gains. It was February, ended yesterday. Well, part of the reason is because the near-term contracts for oil are trading hands at a premium with respect to the farther out contracts. That is a technical term called backwardation. I'm not going to get too technical with you on it, but it does signal that there is tightness in the supply market. Also, taking a look at OPEC Plus and the Oil Alliance with respect to reports that they may be deciding to extend their production cuts into the second quarter, that would also send oil prices higher. We have seen demand coming out of Asia, and that demand has been a little bit more than expected, than forecasted. And finally, we're looking at the Middle East conflict that's happening there as well. You've got those Red Sea tensions, and I've been hearing increasingly from analysts about concerns about the Strait of Hormuz, and that is right up against Iran, and that's considered the choke point of oil, for one of the major choke points for oil. So if there were to be disruptions there, you'd be seeing prices go higher. But look, year to date, we are seeing that WTI is up about 14% now since the beginning of the year. Brent crude is up about 10%, guys.
All right, Ines, thanks so much for tracking the movement that we've been seeing within the commodities market. Well, coming up next, Macy's hit with the downgrade on its turnaround plans. We will speak with the analyst behind that downgrade next.
Macy's hit with the downgrade on Wall Street after announcing turnaround plans in its Q4 earnings report. The retailer under pressure amid high inflation. TD Cowen cutting the stock to market perform from outperform and slashing its price target by $3. The analyst writing that while Macy's may be making the right strategic investments towards long-term profitability, there are some risks in the near term. Joining us now with the call is the analyst, Oliver Chen, TD Cowen Senior Research Analyst. Great to have you here. You're also a retail professor. We got to know. Let's give you all the hats and titles. Research professor over at Columbia Business School. Thanks so much for taking the time here today, Oliver. First and foremost, let's dive into this call here. What really led you to alter, and what did you hear from the Macy's team here in this most recent quarter that really stuck out to you?
Brad, I'm excited about the plans. However, it's a transition year. A lot of this will take time. It's a bold new plan, which involves store closures, product, as well as digital changes. They are good changes. Less is more in retail. The stores definitely need more service, and inventory can be more specialized. So looking forward to it, but it's a transition year that will take time. So I think that earnings estimates are likely to be within guidance and have lack of upside and also have risk. The other part of this, Brad, the stock has run 50% in the past 4 months. So in thinking about valuation, expectations are fairly high as well. So those two things, thinking about the stock, thinking about a good strategy, which will take time, and this being a transition year, moved us to the sidelines.
Oliver, you mentioned the fact that the transition is going to take time. I think a lot of people are asking how much time. Do you have any idea what that timeline could potentially look like?
Yeah, Shauna, the estimates that we're forecasting this year still call for negative growth. So it's really the year after in terms of more sustainable positive growth. And keep in mind, we have a strong consumer now. We have not been able to grow revenues at Macy's since 2022 or before, and this has been a problem. Consistent growth has been a problem. As we think about what's happening at Macy's, they really need to get the younger customer. Also, about half of their profitability is related to credit card income, and there's legislation that's happening there as well. Those are key risk factors. Product needs to improve, and they're working on the private label, and it is getting better, but the younger customer will be critical for the long term in our view. And store traffic has been flattish to volatile. It's not easy to come by.
How does the platform on which they're selling need to improve as well for that younger consumer that's out there, Oliver? Because I think about my own, and I'm not the youngest consumer out there, I will acknowledge that, but I've been noticing this shift in purchasing habits for a lot of younger consumers and finding inspiration on what they're seeing within their feed and being more prone to hit the buy button there than load up the gas, put it in the car, go over to the experience at Macy's, or even decide to go to a specific website alone just to purchase and type that in when it's just in their feed and they can go from there. So how do they need to change that?
Yeah, Brad, I think you're bringing up great points with the social media changes. In particular, what we're seeing is the TikTokification of retail. We also believe in short form video. So what Macy's needs to do is better integrate all these different ways to get to their product, make it easier for the shopper, and continue to be omni, meaning connecting online, offline, and mobile. As we look forward, live streaming, editorial, curation, Macy's is a place that stands for fashion and inspiration and has that kind of magic. It is not trying to be a destination where prices are the main event. So it's an evolutionary process in terms of experiential retail and also being curated. The small format stores are quite positive in that they're much more curated with better service. And service is a key theme too. When all customers walk into stores, they want service in terms of footwear, ready to wear, and they want to be able to check out in an easy fashion. That has not been consistent across all Macy's as well. So physical, digital, social media, the TikTok shop, these are all things we're following.
Oliver, they also have the potential proxy fight here with ArcHouse. ArcHouse had unsolicited a bid for $21 a share. Macy's today just around 17, just over 17 bucks a share. What do you see this potential proxy fight doing to valuation? And do you see Macy's potentially getting up to that premium offer?
Yeah, Shauna, a great point with the proxy fight. What we'll see is continued volatility in the stock. It really depends on the management team they're putting up in terms of potential changes. That being said, on this bold new plan, Macy's announced monetization of 600 to 700 plus million of real estate over time. So the company is well on its way organically to extracting value out of properties. And this is quite a manual long-term process. So we'll see a fair bit of volatility. Bottom line, though, is that this bid is out in the marketplace. So expectations on this are fairly high, and monetization expectations as well. And that's part of our reason for moving to the sidelines. Underscoring Macy's is a lot of cash flow, $1 billion of operating cash flow. And that's part of what makes this attractive as an asset. It's well capitalized and is profitable and generates cash flow as well.
Oliver, you've got our internal Slack channel blowing up right now. I just got to ask you about one more thing. The little luxuries, Blue Mercury, one of the standouts in this interim period of time. Where and how much would you be satisfied with Macy's continuing to make sure that they invest in that part of the business for that next leg of growth?
Yeah, Brad, we're structurally really excited about beauty and wellness and taking care of yourself as well as cosmetics. Blue Mercury is a great concept in that it's a store format that customers love in terms of self-service and having multiple brands and being off mall. So the Blue Mercury growth, as well as Bloomingdale's, which is an iconic luxury banner, which has wide appeal and unique product, those were great ideas for the company to continue to grow. However, they're about 10% or less of overall Macy's. So they're not needle movers, but I'm really encouraged. They should be putting capital towards those concepts. The beauty market is vibrant and growing, and everybody loves it. And Bloomingdale's is an iconic luxury franchise, which has a lot of brand equity and a lot of growth potential.
Oliver Chen, always great to have you here on Yahoo Finance. Thanks so much for joining us this morning, and have a great weekend.
My pleasure. You too. I'm going to the stores right after this.
Oh, there we go. Spending there. Yeah. Brad does his it's pretty much daily channel checks.
I do my Yahoo Finance channel checks, Oliver.
Gucci, Brunello Cucinelli, Macy's. I'll see you there.
There we go.
Thanks.
Wow. Yeah, no, I'm on a different floor, Oliver. I'm sorry.
My budget's a little bit lower. One day, though, we aspire to be heading to those stores on a Friday afternoon. Right, Oliver, thanks so much for joining us. Let's do one more quick check of the markets before we let you go. Now we're seeing green across the board on this Friday morning. The Dow up just about 30 points. S&P up 0.3%. The Nasdaq, the leader of the major averages. Does it for us. Kiko and Rochelle have you for the next hour.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. Happy Friday to all of you. I'm Akiko Fujita, and here's what I'm watching this hour. Pressure piling on regional banks. New York Community Bancorp revising its fourth quarter losses significantly higher and citing material weaknesses and internal controls related to its loan review process. Stocks rallying to close out February, notching a 4-month win streak. Both the Nasdaq and S&P 500 logging their best February return since 2015. But how far can the rally extend? Plus, trouble in paradise. Elon Musk suing OpenAI and Sam Altman, claiming the company's no longer following its original goal to create AI to benefit humanity. Musk saying that instead OpenAI has opted to focus on profit. First, though, let's take a look at where major indices are trading on this Friday. 90 minutes into the trading day, we've got green arrows across the board. The Dow up 44 points, the S&P 500 up 20, and the Nasdaq up 87. A few economic data points to point to that we got today. U.S. manufacturing activity pulling back more than expected in February. Also, we got the University of Michigan's Consumer Sentiment Index falling for the first time in 3 months. Let's take a look at where the Treasury market is right now on the back of that. And we are seeing yields pull back across the curve. The 10-year yield at 4.2% right now, and the 30-year yield at 4.35. Shares of New York Community Bancorp falling to its lowest level since 1996. The bank amending its Q4 results, showing steeper losses and adding a disclosure about its weaknesses in its internal risk management controls. And the bank CEO is now stepping down, but it's taking steps to build more confidence, appointing a new chief risk officer and chief audit executive today. To break this all down, let's bring in Yahoo Finance's David Hollerath. David, you have been covering this story for some time. We are seeing pressure build across all the regional banks today as a result of this as well.
Yeah, Kiko, I think, we'll start by just talking about New York Community Bank. So they put out 3 filings yesterday evening, and then another press release about an hour ago. And essentially, they're going to be late on their annual report. They cited that due in part to material weakness in their internal loan review. So New York Community Bank has a very high amount of multifamily rent-regulated apartment complexes in New York City, and that is complicated for a number of reasons, meaning that a lot of those properties are assumed to have lost value. So that's sort of the nature of a lot of this stress. And that is people use the term idiosyncratic. It's pretty unique in terms of what the kind of exposure other regional banks have to that. That being said, the CEO has also stepped down, and the new executive chairman is stepping into the role of CEO. Now, we want to point out that earlier in February, it was already made that the new executive chairman would become the de facto boss, and the CEO would report to him. So that's not quite as new as much as it is the fact, as you pointed out, that the CEO is stepping down. He's still going to stay on the board of directors, though. But the big change that has come from this has been this huge goodwill impairment that the bank did disclose, even though it's not completely done with re-reviewing its financials for the quarter. So that's a $2.4 billion goodwill impairment. And that's honestly, it's more about stock valuation in the past compared to where the stock is now. It has a lot to do with merger transactions. And it's not connected to the bank's 2 recent mergers, assets from Signature Bank, which failed last year, and before that, Flagstar Bank, which they closed an acquisition on in late 2022. So a lot going on here. But I think as far as what it means for the other regional banks in terms of what this information has told us, the goodwill impairments is probably the most important area. We spoke to Chris Marinac with Janie, who actually covers NYCB, earlier today, and he said he would not be surprised at all if more companies, as the year goes on, begin disclosing these impairments. Again, this has a lot to do with stock valuation. So this is only going to be relative for banks who have done transactions or mergers in the past and have since then, or maybe over the last year, significantly had their stock value drop, changing sort of the valuation of some of these things. But importantly, this kind of impairment, it doesn't affect NYCB's bank capital rules, which are obviously crucial to the bank's liquidity. It also doesn't affect their cash. So it's a very fluid situation. The last thing on the positive side, I think I would just add, is just that they have appointed a new chief risk officer and a new chief audit executive. Both of those positions were empty as of the end of last year, and that wasn't really reported by the bank. Bloomberg actually came out with a story revealing this, and that was a part of some concern investors had just about the governance overall of the bank. So the fact that those positions are filled is quite good.
Either way, it points to potentially still a choppy road ahead for the stock, at least in the short term. David Hollerith, thanks so much for breaking that down for us. Well, U.S. markets, all three major indices in the green right now to kick off a new trading month. Stocks coming off of the best February in nearly a decade, with both the S&P and Nasdaq hitting record highs this week. To break down areas investors may be overlooking, we've got Wei Li, BlackRock Global Chief Investment Strategist here. Wei, it's good to talk to you today. Looking at where things have tracked this week, we got a lot of economic data that essentially points to inflation still being a little sticky, especially on the services side, but some resilience in the economy. How is that, or has that changed your view in terms of the outlook at all?
What is really interesting, good morning, Akiko, is that so far this year, markets have significantly repriced on the rates side. So beginning of the year, markets were looking at 6 cuts, and now just 3 cuts because of the inflationary pressure. So, for example, in January's CPI print, as well as PPI print, also the PCE print yesterday, supporting that as well, showing some stickiness. But despite the fact that markets have repriced on the rate front towards the hawkish direction, risk assets sentiment has been positive. Risk assets have delivered strong return because earnings are very strong. So on the one hand, we have rates. On the other hand, we have earnings. And when it comes to valuing risk assets, it's essentially discounting future cash flow, rates being the discount rate and future cash flow being earnings. So earnings, Q4 earnings are coming in more than twice as strong versus expectation at the beginning of the reporting season, driven mostly by the Magnificent Seven, which is why we continue to have a concentrated market rally, and we stay within BlackRock. We stay overweight U.S. equities with a preference for the tech sector for this reason.
Yeah, wait. Let's hone in on that and take the AI trade aside. You are neutral when it comes to U.S. stocks minus the Mag 7 there. What is it that you see right now that puts you in that position?
Well, we're neutral, the broad equity market minus the AI theme, because if we look at valuations in the US, valuations, the S&P 493, they are still at a level that is above pre-pandemic levels. So in terms of forward PE, it is above pre-pandemic levels. And this is in the context of rates having risen significantly. So typically, when rates go higher, multiples needs to come down. And yet multiples have expanded for the S&P 493. So that doesn't quite add up unless we see meaningful economy-wide productivity gain, which can be boosted by AI, but we're still in early days. So because of considerations around valuation, but also cognizant of what AI can do for the broader economy, when we balance out the 2 factors, which is why we are neutral on the broader kind of ex-tech part of the U.S. equity market. But when we add the strong conviction of AI theme, including tech, including communication services into the U.S. equity mix, we then have an overall overweight for U.S. equities.
Wei, I want to get back to your what you talked about in shifting expectations for Fed rate cuts. You say that you see inflation staying closer to 3%, at least in the strategic horizon here. Is that where investors need to shift their expectation? I mean, you could argue that the shift is already happening, but what would be the case for additional or a rate cut or 2 rate cuts, 3 rate cuts here, given where the economy has been able to track even with inflation above that Fed's target?
Well, there are actually a few nuances in terms of our inflation view. So currently, as you said, Akiko, markets are seemingly expecting more sticky inflation, i.e. the last mile of inflation getting down to target being hard to achieve. We actually don't think that the last mile is that difficult to achieve because of very powerful deflationary forces coming from goods deflation as pandemic mismatch continue to unwind. So in the very near term, so the coming month or so, we actually see inflation falling faster than markets seem to appreciate. And that actually supports our current kind of more positive tone around US equity market. But over the long term, we see markets underappreciating the level at which inflation will settle. So if you look at US 2-year break even, it's pointing to 2.8% or so. We see inflation settling around 3%. So there's a bit of a nuance in terms of our inflation view. So in the near term, markets are not appreciating how quickly inflation can fall because of goods deflation. But over the long term, markets are not appreciating how sticky inflation can actually stabilize around a higher level. And for that reason, we're more positive in the near term for US equity market versus the strategic horizon US equity market view where we are neutral because of concerns around valuation and also the fact that we're then living with higher rates and also higher inflation.
Wei, outside of the U.S., you're quite bullish on Japanese equities. We, of course, have seen corporate reforms as a big catalyst, pushing the Nikkei to new records here. I wonder how much of that momentum you think can continue when you consider the pullback that we have seen in the Japanese economy, and given those comments we got from the Bank of Japan's governor, who essentially seemed to kind of pour cold water on any expectation of a hike, given where inflation is right now in Japan?
Well, if we look at Japanese equity market return, for example, last year, in dollar terms, it's not as good as it was in local currency terms because a lot of the equity performance has been boosted by a weaker yen, currently trending around 150 versus the dollar. So the first leg of the good performance from Japanese equity market has been very much boosted by the monetary policy divergence theme, with Bank of Japan staying very supportive, but the rest of developed market central banks hiking rates aggressively. And the first leg of the return in Japanese equity market were also boosted by the exit from decade-long deflationary mindset. But in terms of the corporate reform, which is hard to come by, which takes time to come through, we believe that there is more room for reform to actually benefit corporate earnings, profitabilities. If we look at earnings revision, Japan earnings revision is actually the strongest among developed market economies. We think that there is more room for the micro news to boost further upside in Japanese equities versus up until now, it has been very much driven by macro development in terms of what's happening in inflation, in terms of what's happening in terms of central bank policies. So now Japan is a bit of a consensus now, but just because it's very much liked by many investors doesn't mean that there isn't more room to go, and we continue to like Japanese equities.
Wei Li, BlackRock Global Chief Investment Strategist. Good to talk to you on this Friday. Appreciate the time.
Thanks for having me.
Coming up, we're going to take a look at the future of streaming, how they're retaining subscribers and growth. More of that after the break. Boeing is reportedly in talks to acquire Spirit Aerosystems, according to a report out from the Wall Street Journal. Spirit, which makes Boeing's 737 MAX jet fuselages and other airframe components, is also exploring selling operations in Ireland, which makes parts for Boeing's rival Airbus. This comes as Spirit has been under fire this year under scrutiny for Boeing's manufacturing problems. Take a look at where those shares are moving. Boeing coming down just slightly here, but Spirit Aerosystem here, that stock was halted temporarily on the news, has now resumed trade. It is up about 17% roughly. According to the report, Boeing CEO Dave Calhoun initially shot down the idea that the company may acquire Spirit. So that breaking story we're going to continue to follow. Well, recent earnings results from media giants like Disney and Paramount Global show that the industry is at a crossroads. Network revenues are flatlining as streaming growth stalls. Let's bring in Yahoo Finance's Ali Canal to discuss more. Ali, it feels like this has kind of been an ongoing conversation. The question is, what is the path forward?
Yeah, that's a big question, Akiko, because for the longest time, linear networks really supported the streaming business. Linear was the driving engine for a lot of these growth initiatives. But as we've seen cord cutting escalate, as advertisers flee linear in favor of streaming and other digital options, we've really seen a sizable drop in that segment. And TV ads in particular has been a big drag on revenue. You're seeing that on your screen now. Paramount Global reporting linear ad revenue declines of 15% year over year in the fourth quarter. Warner Brothers Discovery, a 14% drop. Disney, Comcast, Fox, also all seeing significant dips in the latest quarter. Now you may be thinking, okay, well, linear isn't doing so well, but streaming must be. So overall, a good thing. The issue with that thinking, though, is that margins and cash flow generated by streaming businesses are going to be lower in comparison due to greater required spending when you think about investments. There's greater marketing costs, subscriber acquisition costs. So when you compare that to where linear was, it's a significant downgrade. So that's one issue. Another is the fact that we're seeing streaming growth really stalling across the board. There's a new report out from analytics platform Antenna, which said that churn or subscribers canceling their streaming plans has nearly tripled since 2019 with 104.5 million cancellations in 2023. That is the largest drop in subscribers over the last 5 years. So in the midst of this subscriber slowdown, investors, they still want to see that profitability. There's still this increased pressure to turn profits. And that's why we've seen these companies across the board enact mass layoffs, bundle their offerings. We've seen joint ventures and skinny bundles, but all that really hasn't been enough because across the board, we're still not profitable on the streaming side for most of these companies, the exception, of course, being Netflix and very recently Warner Brothers Discovery. But Warner Brothers Discovery results were interesting because despite its streaming turnaround, it still missed on both the top and bottom lines. Revenue dragged down again by the linear segment. So those results really illustrating this balancing act that all of these streaming and media companies are facing, right? So this is something that we're going to continue to monitor. But after we got these latest results, it's certainly an issue that stood out to me.
Okay, Ali Canal with the very latest on the streaming play there. Thanks so much. Well, it has been a choppy ride for the streaming industry, from cracking down on password sharing to additional price hikes. Consumers wary of seeing their streaming bills rise are starting to push back. More than 140 million subscribers canceled their streaming subscriptions last year. That's the most cancellations in 5 years. But roughly a quarter of customers resubscribed within 3 months of canceling their subscription, according to an Antenna report. For a deeper dive on the study, we are joined by Brendan Brady. He is Antenna's strategy director. Brendan, this is a fascinating study. It answers so many of the questions we've had about these streaming sites. So let's talk first about the cancellations that these sites saw. How much of that is about customers becoming a little more cost conscious? How much of this is about just the sheer number of services that are out there? Customers just can't keep up.
I think it's the latter more than anything, right? There's more choice than ever in terms of where you can access premium film and television content. There's also no switching costs associated with streaming. You can cancel a service in 1, 2, maybe 3 clicks, right? And so we're seeing the consumer become more habituated to moving sort of in and out of these services. And that's sort of been the primary driver of this increase in churn that we've seen as of late.
Yeah, I mean, we're talking about cancellations, but what your study also found that a lot of those customers do come back. So let's talk about the churn. How quickly is that churn happening right now, and who's most affected by it?
So if we look at the consumer behavior around resubscription, which is sort of a core metric of ours here at Antenna, it's really on the rise, the behavior overall of canceling a service first, but then also adding it back. And so if we look at, the 9 biggest streaming services in the US, 25% of customers are coming back within 3 months after canceling. Fast forward to 12 months, and it's about 40% of customers. We see that Peacock and Netflix actually in this past year saw the highest instance of winning back those customers at a quick rate. And I think a lot of it is driven by content, right? So maybe you subscribe to Peacock to watch Sunday Night Football when the season kicks off, and then when the season ends, you might cancel, but you come back, right? And we really see that the consumer is getting, increasingly comfortable with moving in and out of these services with a lot more rigor.
Brendan, any sense on what some of those shows are or those offerings are that bring the consumers back, at least brought them back, if you're looking at 2023 data?
I think it's hard to say a specific title, right? Just given that everyone has different tastes. But, overall, we certainly do see that the consumer will cancel, but then they'll also come back. And sort of the implication there is that services now have to begin to manage these customers, not only over a single lifetime, but really think about their relationship with that platform more holistically.
What's interesting to me, though, even though we're talking about resubscriptions or resubscribers, however you want to use the term, it is still also for these brands or platforms all about getting the new subscribers on board to at least lock them in to these services. What did your study find about how that strategy is working? I mean, that 3-month window you talk about to me is so fascinating because you have to wonder what the calculation is among those customers who've signed up to say, is this something that's worth keeping?
Right. So if you take a cohort of consumers, right, and you see how they sort of decay or cancel over time, it's not linear, right? It sort of decays very steeply and then flattens over time. The more months that you're paying for the service, you're less likely to cancel. And so that sort of month 0 to month 3 window is super fragile and important for these services to really win that customer. And what we found is that there's a high, amount of subscriptions held in those early tenure periods. If you look at the 9 biggest services, 39% of subscriptions that we measure are in their first year of tenure. And if you remove Netflix from that calculation, it goes up to 45%. So nearly half of subscriptions are in their first year of tenure, right? And that's really when you're most at risk to cancel. And so it's really important for these services to consider, who is that subscriber? What else are they paying for? What else are they watching? And really try to manage them so that they can get them past that fragile period and more towards, the area of the survival curve where things start to flatten out.
Brendan, what's the threshold for the average customer? Is it 3 platforms, 3 subscriptions, 4 subscriptions? What'd you find?
I can't give an absolute number, but if we look at it broadly, right, we see that the subscriptions per subscriber is consistently growing. At the same time, churn is increasing, right? And so maybe you have 3 subscriptions in a given month, and the next month you have 2, or the next month you have 1, and maybe the next month after that you have 5, right? We're in a world where there's virtually no switching costs associated with this. Which is quite unlike cable, right? Where you had to call someone, they would have to pick up your box and so on. And so we really see that the consumer is adding services, strongly, but also canceling services with the sort of same amount of strength.
Yeah, easier to do when there's so many options out there. Brendan Brady, Antenna Strategy Director, bringing us that study. Thanks so much.
Thank you.
Well, coming up, American women set to receive financial windfalls from the Great Wealth Transfer. How it could affect you after the break. Elon Musk filing a lawsuit against OpenAI and CEO Sam Altman, alleging the company has moved away from its founding mission of building AI to benefit humanity. The suit filed on Thursday is just the latest in an ongoing dispute between these two tech leaders over the future of AI. Let's bring in Yahoo Finance's Dan Hellie to give us the details. Dan, we're talking about the backdrop to all of this. There's a bit of history between these two.
Yeah, Kiko, a lot more than a bit of history between these two. Elon Musk essentially helped co-found OpenAI. Let me just give you a little bit of background on Musk's side of things. Basically, he and Larry Page used to be buddies. Elon Musk had talked about trying to buy DeepMind prior to Google doing so, but then Google went ahead and did so. That didn't exactly sit well with him, so he wanted to go out and get start his own kind of AI group. OpenAI, Sam Altman and him, as well as a slew of others started the company. The idea was for it to be a nonprofit, so that anything that was built was for the benefit of humanity, it was said. But then Altman and some others had said, we need to get funding. Let's do a for-profit side that the nonprofit board oversees. Musk didn't like that, so he dipped out, apparently not on great terms. And now he's trying to run his own XAI, which is essentially tied up with X, and you have to pay to get access to its chatbot. So they're making money off AI there. And this whole thing is basically coming down to, I guess you could say, ego on the parts of everyone involved. And then this seemingly overarching fear among some in the tech community that AI is going to become, Terminator and destroy us all. Elon Musk subscribes to that notion. Sam Altman seems to have at some point subscribed to that notion. They've both apparently, according to reports, brought up the idea that somehow we're living in a simulation, in which case this simulation is pretty bad. But this is something that I think is going to continue to roil the industry. Is OpenAI continues to be the leader, and so it could be that Musk genuinely has an issue with the way the company's run, with the fact that Microsoft is seemingly doing very well based on the contributions that OpenAI is making to it, or that it's a kind of a personal grudge.
I mean, so Dan, let's pick up on that point, because sure, some would argue that this is just all personal for Elon Musk, but the specific concerns he has raised is not unique to OpenAI, where he's talking about, this technology that was started out as open sourced has become more closed as these companies like an OpenAI, like a DeepMind, have forged ties with the big tech players.
Mm-hmm. Yeah, and look, there's something to be said about these companies, as you said, DeepMind is Google, OpenAI with Microsoft, them having all the access to these high-end models and no one else. And so, that being said, there are open models out there. Meta famously has its Llama as open source. There are other companies as well that offer open source capabilities, and so do Google and OpenAI. They offer some open source capabilities as well. So, but yeah, I mean, it's almost as though the idea that this technology is going to be so important in the future that why have it locked off to certain companies is a concern for some as well. And look, there's been regulators who have been questioning this. There's regulatory scrutiny on OpenAI as far as how Microsoft is benefiting and the tie-up there. So, it's not just Musk who is raising questions, but clearly there's more going on than just whether or not OpenAI has limited access to just Microsoft or not.
Okay, a debate that's sure to follow or sure to continue here. Dan Hellie, thanks so much for that. Well, the great wealth transfer is expected to hand over up to $129 trillion from baby boomers to younger generations, with women expected to be some of the biggest beneficiaries. Ellevest's recent Women in Health survey finds 45% of women have already received or expect to receive that financial windfall. We are joined now by Sally Krawcheck, Ellevest CEO, on the recent survey and how women can work to close financial gaps. Sally, good to talk to you today. Let's talk about this great wealth transfer. It is about the transfer of wealth from generation to generation, but you've said that this has the potential to reshape society.
Oh,
how?
Absolutely. Now, it does have the potential to go from generation to generation, but before it does, it goes from him to her. And recall, women tend to live 6 to 8 years longer than the men in their lives. Half of marriages end in divorce. 80% of women die single. And so what we're going to see with the great wealth transfer is it's going to go from him to her and then to the kids. And the result of which is that women will control more than half of the wealth in this country. And so we're going to move from a world in which men control the money to women control more. We at Ellevest are calling it the feminization of wealth. And when that happens, I'm not going to say everything changes, but a lot of things are going to change.
So let's talk about some of those things that you do expect to change, because, you know, the backdrop to all of this is, of course, when you look at pay, for example, between women and men, there's still a gap there. And so if it is that transfer that happens for women to control more money, how about some of those fundamental issues? What changes there?
Well, so let's start to be a little cheeky. The great wealth transfer should do for women what Lean-In did not. And by the very fact of that money coming to her, what we're finding, which is really interesting, is women become more confident. We've always sort of thought that, oh gosh, we hear about the money confidence gap for women. And so women don't have as much money as men do because they're not as confident. They don't ask for that raise. They don't invest as much as the men do. But what we're finding is it's the other way around. The research demonstrates that when they get that money, they become more confident. So it goes from something like 45% of women, a minority of women, saying, I feel confident around money if they're not getting a wealth transfer, to 80% plus do feel confident, which is actually more than men. What happens when you have a bunch of confident women? Well, one thing, they'll be talking about money a lot more. But another thing is they're more likely to leave their partners and spouses. Particularly younger women say if they get a wealth transfer, a third of them say they would consider leaving their partner. So things are going to be different, including, by the way, women tend to give more to nonprofits. Women tend to believe more in climate change than men do. You see this big donation from Dr. Ruth Gottesman to wipe out tuition for medical students. That's the kind of thing we can start to look for.
So more financial independence. What does it all ultimately mean for the economy?
Oh, as we say at Ellevest, nothing bad happens when women have more money. When that money comes to them, they will spend it. We know of the research that says if you want to improve society, you want to improve a community, you get money to women because they're more likely to invest it in their families. They'll be more likely to invest it for positive impact. Women tend to, more than men, say, yep, I want to invest. I want to invest for a financial return, but I'll take an impact return as well. Thank you very much, without giving up one or the other. So the ripple effects here with this feminization of wealth can be really tremendous. Now, the red flag here is that women don't have the financial support they need fully, that most women do not have a financial advisor. And when and if they come into money, they don't know where to turn. And again, it's the reason for Ellevest being to support women in investing and help them to invest. But this is happening while the industry is looking a little bit the other way.
It is a fascinating study. Sally Krawcheck, Ellevest CEO. Good to talk to you today. Appreciate the time.
Thanks for having me.
Coming up, the roaring growth of sports tourism. We're going to dive into the growth of the business with an expert after the break. Well, sports tourism is making waves across the globe, becoming one of the fastest growing sectors in tourism, according to the United Nations World Tourism Organization. Well, think traveling for big events like the Super Bowl or the Olympics. This requires tickets, flights, lodging, and usually reservations at local restaurants. The United Nations estimates sports tourism has a growth rate of 17.5% through 2030. As part of Yahoo Finance's Travel Guide 2024, we are digging into what the growing business will become. For more on this, let's bring in Paul Kane. He's president of On Location and IMG Events. Paul, it's good to talk to you today. Let's start by talking about where you are right now in terms of this sports tourism boom that we've talked about. On Location, IMG, you're right at the heart of that intersection between sports viewing and experiences that come with that.
Yeah, I mean, look, the portfolio is really interesting because with IMG, we're an owner and an operator. So we are we create and build the events around the globe under the IMG umbrella. The On Location piece of our business is we work with not only IMG, but with global sports rights holders to develop the true experiences that you were just talking about. Because if people want to go to a big event or they want to experience a game, it's more than just sitting in a seat. It's not just the ticket. It's about what they're going to do around it, how they're going to get there, what's their transportation like, what is their experience like, and that's where On Location works across the globe.
So let's talk about that a bit more. I mean, sports, as you say, it's always been a big draw. I'm one of those fans that's willing to shell out a lot of money to see a game or, actually go out and be in the stadium to view this. But it feels like we have seen this shift on how fans think about the experience that comes along with that. What are you seeing about how much they're willing to shell out?
Yeah, look, I mean, there's a huge demand for global sports right now and for global entertainment. I mean, people don't want to just travel. They want to travel with a purpose. And what better thing to do than to go see something you absolutely love? And people are willing to step up and do it. So we're seeing everything from a passion concept to like going to the Super Bowl, or a bucket list, like I want to go to an NCAA final, or even just a dream trip, like I want to go to Paris for the Summer Olympics. Any one of these opportunities around the globe gives a fan an opportunity to do something they've never been done before. So we like to create those like once in a lifetime moments for people. And that's where the experience comes in. So people are willing to spend more and more to get that experience. Of course, the first layer is, what are they willing to pay for the ticket? And then it goes from there is, what do they want to do with the ticket? And that comes with a whole lot. Like in the Super Bowl we just had, we had people after the game on the field during the celebration with the confetti coming down their head. We had people pregame where they were going to experience not only great live music with Billy Idol, but also meeting a lot of the Hall of Famers that were there with us. And we just had the new Hall of Fame class introduced a couple of days prior, and they were at the pregame celebration with the fans. And these are the unique things that we bring to bear. Now at the Olympics, same thing. We're going to bring you and get you to see Olympians from previous games, and you're going to be seeing and hobnobbing with all of the key people around the games. You're going to get to see a site of the games that you wouldn't have had before, whether it's through transportation, special egress, unique hospitality centers, and meet and greet opportunities. That's why you go with someone like an On Location versus just buying a ticket.
And to that point, you already have partnerships in place with major leagues like the NFL. You're a partner with the IOC as well for the Olympics. You just pointed to some additional experiences that fans can expect. What does that mean for additional revenue for your company?
Yeah. So it's more than just what we do for our company. It's what we do for the cities, the hosts, and our partners. There's certainly, as fans want to spend more and do more, then it becomes a great economic opportunity for the host cities, for the rights holding partners, for all of the people around the games. I mean, in the years previously, you would go, you would buy a ticket, and then that ticket, once the venue was sold out, a lot of what came into bear was what was called the secondary, where people go and exchange those tickets at a premium. I've heard terms like scalping and things like that in the past. That is all moving away because companies like us, when we partner with someone like any of the 150 rights partners that we have around the globe, some of those you've mentioned, but some of those you didn't mention, like Major League Baseball or the PGA, NASCAR, then we help them create more value from every one of those tickets, but more importantly, more value for the buyer of those tickets so that they're not just buying an increased price to that secondary, they're getting a higher value opportunity for that premium. So there is more value to a city, more value to a rights holder, but ultimately it's more value to the fan.
Paul Kane on location and IMG Events president. Good to talk to you today. Appreciate you joining us.
Thank you. Appreciate the time.
Home buyers feeling the pinch from higher interest rates could get a boost this tax season. And Yahoo Finance readers share advice they've received on how to best save for retirement. All of that coming up on the other side of the break. Well, recent homebuyers affected by higher interest rates may be surprised to find out that a lucrative tax benefit taken on itemized returns is back in the picture. Here to explain more is Yahoo Finance's Rebecca Chen. Rebecca, what are we talking about?
Hey, Akiko. So on the show, we've talked plenty about how high mortgage interest rate has been hurting home buyers. But today, we really want to highlight how high mortgage interest rate in a rare silver lining can actually help home buyers. And essentially, it is known as the mortgage interest deduction on your itemization, or otherwise known as the Schedule A. So essentially, taxpayers, they can deduct the amount they pay for mortgage interest on this itemization. And as you can see, and if we really talk about how much over here, it's really quite a chunk. Let's say if you recently purchased a home and then you have a loan for about $500,000, you can get a pretty good size interest deduction, which is around the price about $36,000, and that just is way more than the standard deduction that most people have right now. And this really isn't something that has been on the radar for many home buyers because for the past couple of years, rates has been so low that nobody really took advantage of this, and you really can't because it made more sense to go with the standard deduction. But given that today, the combination of high home prices and high interest rate, this is definitely coming back in the picture.
Rebecca, the median U.S. home price is around $400,000. How many new home buyers can actually take this benefit?
So that's a great question, because normally when we think about itemization, you really think about a very few Americans who can take advantage of that. But given today's just basically high home prices, you can see all the new home buyers, even the ones who purchase a median price home or ones below, you're getting almost $23,000 of mortgage interest deduction that you can take on your tax return. And even if the home prices you have is a little bit lower than that, you can tack on other things like charitable deduction, your property taxes, your state income local taxes, and even medical expenses to really push up that deduction. So again, when we're comparing this to standard deduction, if you're recently a new home buyer and then you lock into one of the higher rates, whether it be 6%, 7%, or 8%, even 8%, you're really getting that benefit that you can take advantage of. So a lot of experts I've spoken with said, right now, if you're paying this, your mortgage payment, monthly mortgage payment, and it's pretty steep, just think about how the principal is going towards your equity, but your interest that you're paying is going towards this tax benefit. So definitely what we're seeing is for people to take advantage of this, because this advantage is back in the picture, it's on the table. So if you are in a position to can take that deduction, definitely go for it.
Some good advice there. Rebecca Chen, thanks so much. Well, earlier this week, we reported that the number of savers with more than $1 million in their retirement accounts rose significantly, according to Fidelity Investments. And Yahoo Finance readers had a lot to say about this one. Let's bring in Yahoo Finance's Carrie Hannon, who, of course, wrote the story out there. Carrie, I've been tracking the comments on here. Thousands of people weighing in. What are they saying?
I just loved it, Akiko. We had over 4,000 people right off the bat. They were just on top of this story. And I think there's something exciting about the idea that there's this, bump up in 401k millionaires. And can I be one? Am I one? But here's what I really saw. I was so heartened when I went through, and I didn't read every single one, mind you, but as I went through these comments, there was a common thread. And this was so beautiful. It really was this movement of older people giving advice to younger people. It was as if they were saying, hey, you've got to understand the value of investing and saving and starting right now, because these people that became 401k millionaires were because they were consistently investing over, the average was 26 years. So the message the older people were reaching back and telling younger readers of Yahoo Finance, start now, max out as much as you can put in your 401k to get your employer match. And if you have to start small and gradually increase it. The second big thing of that advice that they were giving to the younger people reading our column was, absolutely do not raid your retirement account. And we saw last year a lot of retirement savers actually did dip into their retirement accounts to borrow money and also just to take it out completely. And we know there are penalties there are taxes there, and in fact, the money's gone, right? And it's just a bad move. And so they tell people not to do that. And the third piece of advice that came out of this, Akiko, is they said there's this real need for financial education. A lot of people were commenting saying employers need to do more to really help employees understand how to invest their 401k money, as well as going all the way back to policy things. High school should be teaching kids about illiteracy, because we wrote a piece, and you and I talked about this just the other week, about there was this retirement literacy test that went out, and most Americans flunked it who took this test. They got a 31%. Now that is a solid F. So, we really need to ramp up education. But overall, the readers were so wonderful, this sense of helping each other out and understand the value of investing.
Okay. You can comment as well for those who are watching now on Carrie's story. We'll continue to track what our viewers are saying. Carrie Hannon, thanks so much.
Thank you.
Let's do a final check of the markets before we let you go. We are continuing to see the Nasdaq push higher here, on track for another record close on the back of that record it saw yesterday. The Nasdaq up 112 points, the S&P 500 up 23, and the Dow up 40 as we head into the noon Eastern hour. That does it for me on this Friday. We've got much more to come here on Yahoo Finance. Keep it right here.